Okay, hello everyone. Today we're going to go over options basics, and I am just going to create this as a mini series and probably put it together as a course for the members. Previously, I've covered some options in the weekend and intra-week analysis of the market, and I just don't think that does the job. I want it to be a little more effective. And I want to take my time with some of these options basics because some of them are a little bit difficult to grasp as a beginner. And even if you are a veteran options trader, the way that I cover these options will give you insight into how I actually use options. So I'll just jump right in and we'll get started. Here is the standard disclaimer I have on all of these videos. Okay, so getting started. Options basics. Equity options are a form of derivative investment. Simply put, what that means is that the value of an option is derived from a security that is traded in the open market. For instance, if you have Amazon issues what are known as options. And those options move up in value or down in value based on whether Amazon's stock goes up in value or down in value. This is because the option value is derived from the stock. So the option value is derived from the stock. So when the stock moves, the options move too. Options can be bought and sold just like stocks can, but not all listed stocks have options. But as time passes, we're seeing more and more stocks become optionable. So why trade options? These are just my opinions. Number one, leverage. Leverage means that you may be able to use less money to gain exposure to the movement of a stock's price. In other words, with options, you gain the market exposure that is similar to owning a stock, but you generally commit less money to make that happen. And that can mean more flexibility for you and your portfolio. Number two, you can profit when the market goes up or down. In the options trading world, you don't have to always expect upward price movement to gain profits. Options traders can earn money whether the market is moving up or down, and this can be accomplished without the use of margin and borrowing of shares. So what this means is that you can trade with a cash account and not a margin account, and we'll talk a little bit more about that in the video as well. Number three, options serve as a way around the pattern day trader rule for many, depending on how they use them. A pattern day trader is considered a trader who executes 4 or more day trades within 5 business days using the same account. These individuals are required to maintain account balances of at least $25,000 in their marginable accounts. The pattern day trader rule does not apply to cash accounts. However, when a stock is sold in a cash account, it takes 3 days for the funds to settle. So if you trade a stock position and you sell that stock position for a profit, the money that you used to purchase that stock will not be available for trading for about 3 days. This is known as T3 settlement. So that pertains to stocks. However, options trades settle in 1 day. Now, the pattern day trader rule and getting around the pattern day trader rules, sometimes this is subject to where you are actually holding your account. I have seen cash accounts where the actual broker still restricts trading based on you doing 4 or more day trades within a 5 business day time horizon. And other brokers will certainly allow you to trade in the cash account without having the $25,000 that you would need to pattern day trade. Another way to get around this, I've seen options traders get around this by actually creating multiple accounts because the PDT rule actually applies to the individual account. So if you have 3 accounts, then you would be able to trade 3 trades intraday in and out in any 5 business day window. You would be able to do those 3 trades in each account. So that gives you 9 trades to be able to do if you had 3 separate accounts. But the problem is you have to maintain 3 separate accounts, and it's just easier to do a single account. So this is just one benefit to trading options I thought I would highlight because I've known several people who have gotten around the pattern day trader rule trading intraday with options. Why trade options continued? Oh, and on the previous point, that would only apply to a cash account and not a margin account. but you can trade options in a cash account. Number 4, limited downside risk when done correctly. So buying options long as opposed to selling them short, which we won't talk too much about, has a maximum risk. Let me restart. Buying options long has a maximum risk of negative 100% of the options premium, which is the amount that you paid for the trade, the amount that you put in the trade. So the largest loss that a trader can incur is minus 100% of the price paid for the option. However, options returns can far exceed 100%. It is quite common to see option returns of 200%, 300%, or even greater returns. The greatest return I've seen in a single day period on an option was around 3,000%. Now, that was definitely an outlier and something that stands out in my brain as something that was absolutely nuts, but it was a 3,000% return in one single day. However, risk is subjective, and limiting risk requires the individual to determine what he or she is comfortable with. So some people may read this and go, oh my gosh, I could never lose 100%. Well, the loss is only large or small relative to the potential gain. The amount of money that you place in the trade is really what determines how much you are going to make or lose. So previously, if you were to buy a stock and you limit your risk at 2%, let's just say you have $100,000, just for easy math. Let's do $10,000. $10,000 for easy math, and you put that into a trade and you set your stop to where you can only lose 2% of that trade. Well, trading options, you don't need to put the $10,000 in that trade. You just put the 2% that you're willing to risk. And under no circumstance will you ever lose more than that 2%. See, if you are just risking 2% of a $10,000 trade, if your stop is not executed correctly, if there's a gap against you, if there's a number of issues with the actual execution of that stop, if the bid-ask gets extremely wide and the stop executes you at a much larger, the market maker executes the stop with a market order that gives you a much larger loss than you anticipated, none of that applies. None of that applies here whatsoever. The money you put in that options trade is the only money that you can lose. And for me, that has given me a very large edge in the markets. We will talk about that more going forward, so I'm not just going to skim over that, but I do want to get back into number 5 here. Investment income. Likely one of the most popular ways to use options is to sell them against a stock position that you already own. The idea is to sell the right to buy the shares of stock that you already own at a price higher than current. So let me give you a brief example. Let's just say that you purchase QQQ ETF. And just for easy math, let's say that QQQ is trading at a round number of $300 per share. And you own 100 shares. So you have 100 shares of QQQ and it's trading at $300. You can take a call option that is for $310, let's say, and you can sell the right, you can sell the contractual right to buy those shares at $310 by the end of the month. Okay? And if QQQ does not reach $310, then what effectively happens is you keep the entire premium of that call option. And you also keep your shares because they cannot execute those call options unless QQQ actually goes above $310 by the end of the month. So what people will do is they'll own 100 shares of a stock or 200 or 300 or 400 shares of a stock, and they will sell options either weekly or monthly against those shares of stock. They keep those shares of stock and the premium goes to 0 on the options, and they also keep that money as well. So it adds income to their long-term portfolios. I just went over that very quickly as well. Don't harp on that. I will do an entire video on how to sell covered calls. But this can add anywhere from 3 to 6-ish% to your annualized returns on your long-term portfolios as well. So it's a very interesting thing. And worst case scenario, they actually buy your shares. Say you sold, say the stock is $300 and you sold the right to buy at $310. Worst case scenario, they actually purchase your shares at $310, which is $10 more than where you currently are. It's really a win-win situation no matter what. All right. Typically, options sold will expire worthless, allowing the investor to keep the premium of the options and the stock shares as well. And this will be covered in detail later on. I just want to highlight this as a perk to trading options. Number 6, flexibility. While a stock is a stock, the available options correlated with the stock are really diverse. Options can be bought at any stock price, at any time, and with many, many expiry choices. The trader's free to choose the option that best fits his or her strategy, risk, and time horizon. So options give us a whole lot of flexibility. All right, so points that I want to cover on options. I've covered these already in some videos, but I just want to do it in a more refined way, pointing out more specific details. Options have expiration dates. Option pricing and expiration dates can be found on what are known as options chains. The picture that you see on this slide is an options chain. Options chains are listed by expiration date. So on this options chain, the expiration dates are found here in this yellow square. The expiration date is the date at which an option expires totally and utterly worthless. I'm really trying to emphasize to you that they will be worth absolutely nothing on the date that is listed for whatever date that you purchase. So pay very close attention here. All right, if you can see my cursor right here, these are just panes that are contracted or expanded. What I did was I expanded the March 12th weekly options so that I can see the pricing and the various strike prices. We'll talk about this in this video as well. Right now, I'm just talking about the expiration dates. The important thing to understand from this slide is that options are listed by various expiration dates. And on these dates, whatever options you buy, so here, if this is listed as March 12th, 2021, I can buy put options or call options. We'll talk about that in this video as well. But I can buy either of those, and no matter how much they go up or down, they will expire worthless at the close on March 12th of 2021. So it's very important to understand. If I were to come down here and look at the April 23rd, 2021 options, then I could buy those options and I can benefit from them going up in value, or I could lose money, or I could do a number of things. But on April 23rd, 2021, no matter what those options do, they will expire worthless. So they have a shelf life. You will notice on the left that we have two types of options. In the darker shaded areas, those are weekly options. And in the lighter shaded areas, these are monthly options. Years ago, there was no such thing as weekly expirations. Each option was listed for a month, and each option always expired on the third Friday of the month in which they were listed. I'll say that one more time. Each option was listed by month, and they expired on the third Friday of the month in which they are listed. However, today, we now have weekly options, which give us a whole lot more flexibility. So March 5th, March 12th, that's a weekly option. You'll notice March 19th is not a weekly option. This is the monthly option. March 19th, I don't even have to pull up a calendar, but March 19th is going to be the third Friday in March. And if I come down here to April 16th, that is going to be the third Friday in April. See, that's the first Friday. It's a weekly option. The second Friday is a weekly option. The third Friday is the monthly option. The fourth Friday is the weekly option. So they're all just the same. It's just showing which ones are monthly options, which ones are weekly options. Typically, the monthly options will have more liquidity because those forms of expiration dates have been around significantly longer than the weekly options. All right, options, calls and puts. A call option is an option that should increase in value as the underlying stock increases in value. I'm going to break this out further in the video as well, so stay tuned. But essentially, if you expect that the stock price is going to rise in value and you want to make money off of that rise, you would buy a call option. Inversely, a call option should decrease in value if the underlying stock decreases in value. So if you expect a stock to go up in value and you buy call options to capitalize on that upward movement, and the stock actually goes down in value, well, then you will lose money on those calls because they will go down in value as well. So if you were to buy Amazon calls and Amazon stock rises in value, then the value of your Amazon calls should rise as well. They will rise. It's just, I say should, because if you buy the incorrect options or you don't understand exactly what you're looking at, sometimes they won't go up in value. But if you pay attention to what I show you and how I teach these options, you won't have that problem. A put option, on the other hand, so I'm going to just focus here. We're now on to puts. A put option, on the other hand, works in the opposite way of calls. A put option will decrease in value as the underlying stock increases in value. So that same example, if you expected Amazon to go up in value, as Amazon goes up in value, the put options will go down in value. Just think opposite, all right? Therefore, a put option should increase in value if the underlying stock decreases in value. So when do we buy puts? We buy puts whenever we think a stock or an ETF is going to go down in value. Because as a stock goes down in value, put options go up in value. So if a call option goes up in value when a stock price goes up, a put option will go down in value when the stock price goes up. If a call option goes down in value when a stock price goes down, a put option will go up in value as a stock price goes down. So if you were to buy Amazon puts and an Amazon stock decreases in value, then the value of your Amazon put should actually rise in value. And this is how you make money using options when the market goes down. But since buying a put is technically a long position, so a lot of people think that buying a put is like shorting a stock. No way. It is not. Because when you short a stock, you are selling. That is a sell transaction. You sell to open and you buy to close. So this is not a short. Short implies selling first. If you buy a put, you are buying a long position. It's just that puts go up in value as stocks go down. A margin account is not required to purchase puts because you're actually doing a long transaction. You're not borrowing any money to short a position. You're buying a security long. You're actually buying a put. You're not selling it. The margin account is not required to purchase them. So you can make money when stocks fall simply by using a cash account, and a margin account is not required. I just want to highlight on this options chain here that you can find calls listed here. Each call will have a bid price and an ask price, just like stocks do. Each put will have a bid price and an ask price, just like stocks do. All right, we'll go over some more of these other columns a little bit later in this video. But on to the next point. Options are listed by strike price. All calls and all puts are listed by what is known as the strike price. Very important here, so I underline this. The strike price is not the price that you pay for the option. The strike price, that's a typo right here, it should say the strike price is referring to the price of the underlying stock or ETF whose options you are looking at trading. All right, so let me just highlight where you can find the strike price on this options chain. So you'll have a strike price in the middle. The price that you pay for puts is right here, correlated with each strike price. So at a strike price of, we're looking at Amazon, and I took these screen captures last week, so it's not accurate as of today. But at 2,900, if Amazon were trading at 2,900, when I took the screen capture, it was trading at 2,920. But at 2,900, you can buy puts for $54.80 bid price, $55.80 ask. So this is what you would pay, it would be $55.80. Or you could buy calls, $77.40 ask by $76.25 bid. So if looking at a strike price of 2,900, if you thought that Amazon was going to go down and you wanted to make money on the move down, you could buy these puts at 55.80. If you thought that Amazon was going to go up, then you can buy these calls at 77.40. We'll talk more about how to select strike prices later in this video. So the strike price is actually referencing the price of the underlying stock or ETF whose options you are looking at trading. So as I mentioned, for each strike, you'll find a listed call option and a listed put option. Each call and each put will have their own pricing in the form of their own bid and ask, very similar to how stocks are listed, with each strike price representing a different call and a different put pricing. I'll talk more about how these are actually priced as well, but you will notice the point of this slide is that options are listed by strike price, and each individual strike price has its own correlated puts and calls. All right, so if you can get that from this slide, that's what I want you to understand from this slide. Options are listed using options chains. Now, we've been looking at these the whole time. In the previous slide, I was taking a screen capture of what's known as Option Station Pro. It is the greatest. It is the greatest platform for evaluating options I have ever seen, and it's built in as an app on TradeStation. Absolutely loved when they came out with that years ago. It's just very helpful. What I did on this slide is I included a different options chain because not all options chains look identical, but they do present the same information. It just the user interface, if you will be slightly different. So cosmetically, it can be different, but it's going to have the exact same information contained in it. What this options chain is showing is calls on the left, puts on the right, and then you have your strikes in the middle. 28.90, 29.00, 29.10, 29.20. This is Amazon again. And they are listed and broken out by expiration. So here's your Friday, March 5th expiration. Here's your Friday, March 12th expiration. So for each one of these expirations, they're going to have the same strikes, and the puts and the calls will be priced differently. Options chains are also sometimes called options. Hit the microphone. Options matrix. This is just a listing of available options contracts for both puts and calls for a given stock or ETF. These chains are listed by expiration date, as I pointed out here. All of these prices are correlated to this expiration, and all of these prices under this expiration. And there's a lot of important information to be found here. Each chain will show calls. Typically, it's on the left, maybe not always, but typically on the left, you will find your calls, and you'll see your puts on the right side. Strike prices will be contained on these options chains as well, and there will be specific pricing information for both calls and puts. So you're going to have your bid price and your ask price. There's going to be a volume. There's going to be implied volatility. There's going to be delta, gamma. There's open interest. There's a number of these columns. Right now, the things that I want you to focus on are understanding the bid and the ask. Okay, none of this other stuff is important right now. Understand that there are expiration dates. There are strike prices that have to do with the actual underlying stock, or I may be overarching. It might be a better way to describe the stock, but they have to do with the stock price, not the options price. And for each strike, there are listed puts and there are listed calls, and each put and each call has a bid price and an ask price. That's what I want you to understand from here. But we're going to come back to options chains the more that I educate on options, and we'll talk about the other various columns and how to use those as well. All right, so options can only be purchased in contracts. While options chains list all available calls and puts by strike price, it's important to note that they must be purchased in what are known as contracts. Now, there's nothing additional you need to do here. You'll just notice that this reflects in your order bar when you go to purchase an option. What I mainly want to cover here is that one options contract consists of 100 shares of the underlying stock or ETF. Therefore, if you're looking at Netflix put options, you have to pay 100 times the ask price for those options. This is because in order to purchase the option, you must purchase them in a contract, and a contract is always 100 options. Again, you must multiply the ask price for any option by 100 in order to get the full amount of the purchase price for one contract. This applies to both calls and puts. So if we're looking at this options chain and we're looking at Netflix stock and we want to buy a put on Netflix stock, it's currently trading at $504.79. And let's just say we want to buy the $500 put. All right. We have a bid price of $10.05. We have an ask price of $10.65. All right. So what we're going to have to pay, because we always pay the ask and we sell at the bid, what we're going to have to pay for the $500 strike put option is $10.65. $10.65. What I'm trying to show here is that you cannot just pay $10.65. You have to buy this in what is known as a contract. So the minute you try to buy this $500 strike put, it's going to populate in the order bar as $1,065. Why? Because it's automatically going to show it in a contract, and it's going to be 100 options. So you have to take this price and multiply it by 100. So you cannot buy this. You can buy it at $10.65. It's just that you have to buy 100 share round lots. So if you want to buy, you can buy one contract, two contracts, three contracts, four contracts, but it's going to be 1,065. Then it's going to be 2 times that for 2 contracts, 3 times that for 3 contracts. That's just how it works. It's the same thing if you were to buy calls. With all options, it works that way. You can purchase more than one contract at a time, but each contract will always represent 100 options. Now, I've started to see smaller lot sizes. So they do exist now, where I think some brokerages are letting people buy them, like in little mini contracts. But the prevailing way to do this, the way that it's always been done, is 100 contracts. And you're going to see that way, way more often than anything else. So most brokers offer options commission structures based on a price per contract, unless you're using a broker that allows you to trade options commission free. So here's a little tidbit about that. I would not skimp on options execution. In other words, what I would mean is I'd pay the price. I'd pay the price. When you get this for free, you get exactly what you pay for. I opened a separate Webull account just because I know a lot of users are on Webull. And this past Friday, I bought call options on the Dow. And when I bought those call options on the Dow, I decided to just buy them through my Webull account. I bought a portion at least through my Webull account. The rest I did through TradeStation. I noticed on the purchase, I was able to get a better fill price on TradeStation, which the difference was about. So let me back up one step. TradeStation charges me a rate of, I think, about 50 cents per contract. So if I buy 3 contracts, it costs me $1.50 to get in and $1.50 to get out, which is very cheap. But just based on my execution, this is how you can be penny wise and pound foolish. When I went to buy those options, now that I couldn't do them simultaneous at the same exact time, but I was able to get a fill that was about $30 better per contract using TradeStation than I was Webull. All right. So I paid $1.50 in commission to get in. Well, I won't tell you exactly how many contracts I bought because I didn't pay $1.50, but let's just say if I were to buy 3 contracts, I would pay $1.50 to get in. And on each contract, I saved about $30. So I'd save $90. So you would spend $1.50 in that case to save $90 on your execution. It's a big deal. And it's accentuated even more with options because that little small penny or two discrepancy is $1 when you consider the fact that you have to buy 100 options for a contract. And it's the same thing when you get out. So I sold some of those call options this morning, and when I sold them on TradeStation, I was able to get filled at a price that was probably, I'd have to go back and look at the math, but it was $40 or $50 per contract difference than what I was able to get at Webull. And so I think a lot of people that are using Webull are maybe not aware of that type of thing. And let me think. I'm trying to just make sure I say this accurately. Yes, I've traded options on Robinhood as well, and it's the same situation. And I think a lot of people, Robinhood doesn't even show a bid ask, so you don't even know that you are getting taken advantage of. And another thing that I just want to cover, I will cover this in detail in the future. I just want to mention it while it's on my mind. We buy and sell options contracts with limit orders. We never, ever do this with market orders. Never. You will lose so much money trading with the market order, because one of the things that you'll notice is that these spreads are wide. These are not wide spreads for options. All right. But these are much wider. If you've ever traded, if you've traded Forex or you've traded stocks, which I know most of you have, then you might see a penny or two on the spread. These spreads are 50 cents. So that's 50 cents times 100. All right. So what ends up happening is if you just put in a market order, they are going to fill you at this bid price every time. Lots of times they'll fill you worse than the bid price. So you might go to put a market order in, say you're on Webull and you just put a market order in. And this is one thing I've noticed about both Robinhood and Webull is that, on both of those, actually, let me think. Let me correct myself. I'm mixing things up here. I did not trade options on Robinhood. I think I was noticing this trading ETFs on Robinhood. Let me just gather my thoughts. I don't think you can trade options on Robinhood. So let me correct myself, because this was probably about 6 months or so. I opened a Robinhood account just to try to do this. No, on second thought, I don't think I was mistaken. I just don't want to ever tell you anything that's not true. I ended up moving over to Webull because they actually give you a bid-ask spread, and a lot of times you're wanting to get filled in this spread. There is no bid-ask on Robinhood, so it just doesn't end up working out that great. But my point is, TradeStation, if you have an 830 bid and an 880 ask, if you put your limit order in for, say, 870 or 860, a lot of times you can get filled at 870 or 860. Now, I just want you to think of the difference. If you put in a market order and you're filled at 830, and I do the same thing per contract and I'm filled at 850 or 860, then I'm already up $30 or $40 per contract from where you start. And so it's really important to get the best executions while trading options, and trying to save 50 cents or $1 per contract is going to cost you a whole lot of money in the long run. That's the basis of it. I created accounts in some of the free platforms just because people ask me about them. I can tell you that I left Robinhood very, very unimpressed. Looking at Webull, I think it's okay. But again, I'm coming from the perspective of paying for brokerage services, for getting very good executions. And, so I'm not very impressed by those things. They seem like platforms that are used to lure new traders in. And, I just did it this morning, and my option execution was horrible. It was horrible on the DIA calls that I bought. Even trying to use limit orders, I could not get filled. I just literally could not get filled with my limit order, and TradeStation just took it, boom, executed it. It was over. So I had to lower my limit. I still got filled within the bid-ask spread on Webull, but it just wasn't great. But I digress. I digress from that. Let's move on to call options. All right. A call option is a contractual right to buy a certain security at a specified price by a specified date. It just hit me why I was confused about Robinhood. It was short selling. I think it was short selling that they would not let you do on Robinhood. That's why I was getting confused. They do let you trade options. All right. Sorry. A call option is a contractual right to buy a certain security at a specified price by a specified date. Notice I highlighted buy, price, and date. So I'm actually going to translate that for you. Buy means call, right? Price means strike price, and date is the expiration. All right. So a call option is the contractual right to buy a security at a specified strike price by a specified expiration date. That's essentially what we're doing with call options. Now, on this example, I want you to assume that QQQ is currently trading at a value of, let's say, $301.10. All right. So the closest strike price to where the stock is currently trading is known as the at the money strike price. All right. At the money. That's what we always call that. So if you hear me refer to the at the money call, I am talking about the strike price that is most closely associated with where the stock price is right now. All right. So if QQQ is trading at $301.10, 302 would not be the at the money. 300 would not be the at the money. 299 would not be at the money. At the money would be 301 because it's only 10 cents away from the actual stock price. Now, let's talk about the in the money calls. So for a call, the in the money price is going to be any price that is less than the current stock price. All right. Now, in the example of the stock being $301.10, I do understand that 301 is 10 cents less than we're currently trading at, but I still would not consider that in the money because 301 is the closest strike. That actually takes the position of at the money. So anything less than 301 will be in the money. We'll talk more about what that means here shortly. Out of the money is any price that is greater, any strike price that is greater than the current at the money strike price or the current stock price. So if we go up to 302 for a call, that's considered out of the money. All right. A 303, 304, 305, 306, 385, 400, anything greater than the current at the money strike is considered out of the money. Anything less than the current at the money strike is considered in the money. This becomes important on this slide. Call option pricing. In the money and out of the money directly affect pricing, and I'm going to explain how. Call options are priced based on three main components. Those three main components are intrinsic value, that is how far in the money the current strike price is that you purchased, time value, which is how long until the options expire, and then volatility. This is how much volatility is expected, and this is known as implied volatility. So in other words, all things being equal, if volatility around earnings is anticipated, the actual premium of the option will go up in value because the amount of implied volatility within that option is actually being ratcheted up by the market makers. We'll talk about that too in the future. But let's go back to this same example where we have QQQ. Remember, let's assume that we're trading at 301.10 cents. The at the money option, the at the money call option is $301. The in the money calls are any strike price less than $301, and the out of the money calls are any strike price greater than $301. So, call options are priced based on three main components, and the first is intrinsic value, which is how far in the money the actual strike price is that you purchased. So let's talk about that. Your intrinsic value is found right here. Now, some of this is hard to comprehend. Let me try to break it down for you in this way. If the current stock price is $301.10, and a call is the right to buy a stock. All right, we covered that in the previous slide. A call is the right to buy a stock at a price by a certain date. I want you to think about it. Which one of these would be more valuable if the stock is trading at $301.10, would you rather have the right to buy this stock at $295 per share or $305 per share? Well, $295 per share is currently $6.10 less than where the stock is trading. So obviously that is very valuable because it's always better to buy at a lower price. You don't want to buy at a high price. Now, if you were wanting to look at the $305 strike price, well, would that be worth very much? No, because I can buy it right now at $301.10. So if I bought the right to purchase it at $305, that right is going to be very, very cheap. There is no intrinsic value whatsoever. So if the stock is trading at $301.10 and I purchase the right to buy it at $295, that option is going to be way more expensive because I have $6.10 of intrinsic value. Sorry, I was putting my cursor on the wrong screen. It's the problem having multiple screens. If the current price is $301.10 and I buy the right to buy the stock at $295, that has $6.10 of intrinsic value. So that $6.10 is going to be reflected in the price that I pay for that option. So the further in the money you go with a call option, the more expensive those options actually are because they have intrinsic value. And that intrinsic value must be reflected in the price of the option. Whereas at $301.10, where QQQ is currently trading, if I bought the right to buy QQQ at $305, that right is very, very cheap. Why? Because I can buy it right now in the open market at $301.10. Why in the world would I ever want the right to buy it at $305? Let me explain. Currently, we're at $301.10. But imagine if through technical analysis, we suspected that in 2 weeks, the price was going to move from $301 to $310. Okay? From $301 to $310. So I buy the 305 calls, which gives me the right to buy the stock at $305. And let's say that I buy an expiration date that is 3 weeks out because I think this move is going to happen over the next 2 to 3 days. But I give myself some extra time and I buy 3 weeks of time. So I buy 3 weeks out from now, an expiration date that expires 3 weeks from today or this Friday. And I buy the right to purchase QQQ at $305 when it's currently trading at $301.10. I'm going to pay pennies on the dollars for this right because currently at the current stock price where it's trading, $305 calls are worth almost nothing because anyone can buy it for cheaper. But if in 3 days the price goes from $301.10 to $310, and I have the right to buy at $305, now all of a sudden $305 will be $5 in the money. This options chain will shift, okay? Because the at the money at $310 price will be $310, and the 305 call is going to be way in the money. All right, so let's just say, for example, we're $301.10 right now, and I buy the 305 calls knowing that the price is likely to go to $310. To purchase those 305 calls right now, I might have to pay $1 per contract. When this price goes from $301 to $310, those $305 call options that I only paid $1 for now have $5 of intrinsic value added to them. This is how options make 100, 200, 300, 400, 500% returns. So the one thing that we really need with options is a lot of volatility and a lot of price movement. So it's very important to pinpoint our entries because we need options trades to work right now. That's why I will enter stock trades very often on the white workspace because it gives me a broad time horizon of where something can work itself out. And I will purchase options using the black workspace because it's telling me what is likely to happen right now. And I need this to happen right now because I have time value built into the option. And the closer I get to expiration, the less time I have. So every day, options lose value if they just sit still. You need them to move. So again, if the stock is trading at $301.10, if I buy the 295 calls, I'm going to have to pay a certain amount for the implied volatility. I'm going to have to pay a certain amount for the time that I bought, which is 3 weeks. And then mostly I'm going to have to trade the difference between this price and this price. I'm going to have to pay that in intrinsic value. So this $295 option is going to be really, really expensive compared to this $305 option, because the $305 option has 0 intrinsic value. The premium for the $305 option only consists of time and implied volatility. And so if I'm smart enough to foresee, or at least expect, a high probability of a move in the future that is going to pass the 305 strike and actually give it intrinsic value when the stock price passes 305, it goes to 306, 307, 308, then that 305 has a massive potential for actual appreciation. I didn't plan on covering this here, but I want to include a little bit for everyone. A lot of people, if the stock price or the ETF QQQ is trading at 301.10 and they think that it's going to go to actually $310, they will buy the $310 call. That is senseless. Why is that senseless? Because you don't buy the call at a strike where you think the price is going to go. Because remember, the price has to pass. It has to go past the actual strike price that you bought in order for that strike price to gain intrinsic value. So at 301, that's at the money. If the price goes to 302, these will become at the money and 301 will be in the money. At 303, the 302s will be in the money and 303 will be at the money. So if we thought the price was going to 310, we wouldn't buy 310 because we need the price to actually go past 310. And for every dollar it goes past 310, the 310 strikes will gain $1 of intrinsic value. So we have to be smart about what strikes we purchase. And I will cover that more in the future. The other thing to keep in mind is that the further you go out with expirations, so we have a March 5th expiration, a March 12th, a 19th, a March 26th, right? The further we go out on expiration, the more expensive the premium is for the calls because we are adding more time and we have to pay for that time. So there's intrinsic value, there's time, which has everything to do with the expiration we purchase, and then there's implied volatility, which we can't do a whole lot about, but there are some things we can be aware of to mitigate that implied volatility. Put options. So it's just like calls, but they work inversely. The reason they work inversely is because if you remember, when we were buying calls, we were buying the right to buy a security. With a put option is a contractual right to sell a certain security at a specified price by a specified date. So let's break it out. Sell means put. Price is referring to the strike price. Date is referring to the expiration. So same example, QQQ, $301. Let's just assume it's trading at $301.10. If that's the case, how we calculate the at the money strike is no different. All right. At the money is at the money, no matter if you're buying a call or a put. What does change is the in the money and the out of the money. You'll notice that they were flipped and they were inverse. So the in the money for a put option, in the money is any strike price that is greater than the current stock price. And the current stock price dictates what is at the money. So another way to say it is any price that is greater than the at the money strike is actually in the money. And any price that is less than the current strike price or the current stock price is out of the money. All right. So it's just the opposite. It takes a little bit of practice to get this in your brain so that it doesn't throw you off. But with a put option, because you are buying the contractual right to sell a certain security at a specified price by a specified date, the in the money put options are any price greater than the current stock price. The out of the money put options are any price that are less than the current price of the stock or ETF. So let's talk about pricing put options. Put options are priced based on three main components. There's intrinsic value, there's time, there's volatility. It's the same as calls. It's just that that intrinsic value is calculated inversely. All right, so QQQ, same example. Stock is trading, or the ETF is trading at $301.10. Sorry, I mess my words up sometimes. $301.10. So the at the money, still 301. In the money, anything greater than 301. Out of the money, anything less than 301. So now our intrinsic value is here. So remember when we talked about calls, I said that you always want to buy at a lower price. That's pretty much a universal rule. If you're buying something, you want to buy it at the lowest price possible, right? Well, puts are the opposite. You are buying the right to sell a stock or ETF at a certain price by a certain date. So this is all about the right to sell, not the right to buy. And when you sell things, you always want to sell at the highest price, not the lowest price. You want to sell at the highest price. So therefore, the right to sell at 302 is greater than the right to sell at 301. And the right to sell at 304 is greater than the right to sell at 302. All right? So the point is the in the money, out of the money. It's just flipped. It's just inverse, or inverted, I should say. So let's think about an example. So it's $301 right now. The current stock is, or the ETF is trading at $301. And you suspect that the price may fall down to a level of 290 based on your research and technical analysis. If you buy the right to sell this stock at $305, well, that's going to cost you a good bit of money. You're going to pay for the implied volatility. You're going to pay for the time, and that's going to depend on what expiration you buy. And you're going to pay for the level of intrinsic value that is contained within that strike price based on where the current price of the ETF is, or stock. So $301.10, just assuming that's where the ETF QQQ is currently trading. If you bought the right to sell at 305, well, that's $4 higher than you currently are. So it's trading at 301.10, but you're buying the right to sell it for $4 more than it's currently being traded. You will pay that difference in intrinsic value. But if you bought the right to sell at 295, this is going to be extremely cheap. Very cheap, because you can sell it for $301 right now, or $301.10. You can sell it for that right now. So buying the right to sell it for $295, which is $6 cheaper, that right is going to be very cheap, which means that put, which is that right, is going to be very cheap. Now, this is worthless until, I shouldn't say worthless, it will have some value, but it's going to be very cheap. But this will not likely appreciate in value until the actual ETF or stock price falls past 295. As soon as the price reaches 295 will now be at the money. As soon as the price goes to 294 or 293, 295 is now going to be in the money. So every dollar that the actual ETF or stock goes lower than 295, when it goes to 294, there will be $1 of intrinsic value added to the price of the put at this strike price, which you already own. At $2 less, at $293, there's going to be $2 intrinsic value in the 295 strike put. At $290, you're still going to have some time left. The implied volatility will still be there in the option, but now if the price is $290 and you purchase the 295 puts, you will have $5 of intrinsic value built into this, and what you paid is going to be up 100, 200, 300, maybe even 400% from where you bought this, right? Because you bought the right to sell QQQ at $295 when QQQ was trading at $301. And because that really didn't have any value at the time, you paid pennies on the dollar for this right. But now QQQ is trading at $290 and you still hold the right to sell it at $295. Now all of a sudden this becomes very valuable. That's how options go up in value and down in value. But think about this. If you bought the 285, I don't have that on the screen, but 285 puts, and the price fell from $301 to $290, but you have bought the right to sell at 285. Yeah, they'll become a little bit more valuable because now you're closer to it. But 285, if the price is still at 290, has zero intrinsic value, and therefore you bought the wrong strike price. So understanding the expected duration, which gives you your time, and the expected magnitude of a trade will help you intelligently select the proper strike price. The further you go out of the money, the cheaper they are, but that comes at the risk that the movement you're anticipating does not pass your strike price when it goes down. All right. The further in the money that you buy, well, that's going to be more expensive, but on a dollar for dollar move, the actual dollar is going to translate more into the in the money options, but you pay higher premium for that. So your actual return on investment as a percentage is going to be significantly less. I know that's a lot to unpack, but I'm just giving you the information and we will dive in deeper as we go along. This video is about to come to an end. It's already almost an hour long, but I just want to highlight, similar to how I did with call options, the further out in time, depending on expiration you buy, the more money is attributed to the premium of the actual option. That's the time value. And therefore, that premium that you will pay for the put option is going to increase. So it will be more expensive the further out in time you go. All right. So these are foundational elements. These are foundational building blocks. I can't teach you option strategies. I can't show you what to buy, how to buy, all those types of things, or educate you on what may be an intelligent decision as far as choosing a strike price or choosing an expiration date. I cannot do that until you understand this foundational information. All right. So feel free to give me comments and feedback. I want to be effective. That's my big thing here. I want to be effective in teaching you how to do this. And I'm not being effective if you're not understanding what I'm saying. I know that everyone's at different levels. Some people will absolutely pick this up and understand it. Some people had a lot of aha moments, and some people may be left confused. I don't want to leave anyone behind. So send me an email if something about this was confusing, and I can talk about the specific details with you. When I first started learning options years and years ago, I thought I would never comprehend this. I had no idea, and no one explained it to me the way that I just explained it to you. I was just reading books, and I was just like, man, this is way over my head. But I knew if I could understand it, typically for me, the things that are hardest to understand lots of times can bring the most value to me. So I wanted to understand it. And eventually, here we are 12 years later, and it's like tying my shoes. It's so easy. But at the time, I just could not comprehend it. Some years later, I sat and took tests for securities licenses, which is one of the big reasons I cannot give buy or sell advice. I hold multiple licenses. Those licenses are pretty much utterly worthless. All that license means is that you know how not to get sued. It means nothing about your ability to actually make money in the stock market. Absolutely zero. But I digress from that. The point is when I sat for those security licenses, every single person in that room was so afraid of options. So you have to take a test on bonds and different securities acts and when different legislations and laws were passed. And when you're done, you become a stockbroker, pretty much. That's what you are. But in order to do that, there's a section of the test, especially in the Series 7 designation, where you have to pass an options section. And every single person that I studied with, or everyone who was doing test prep with me, they could not stand talking about options. And even the instructors were like, hey, all you have to do is pass this part about options. Once you become an investment advisor, you'll never have to talk about options again. And I thought that was so interesting because at that time I had been studying options for about 5 years. And so that part of the securities exam, I made a perfect score because I was like, this is what I do every day. I didn't do as well on the bond part just because I've never had a whole lot of interest in bonds, but I'm definitely understanding their value as I get older. But the point is this is just hard until it becomes easy. Send me your questions. You're not alone. The whole point of me talking about securities licenses and all that stuff is that very intelligent people find this subject matter to be very difficult to comprehend and digest at first. But drop by drop, you can absorb all of it. All right. So don't be discouraged. If some of this was a little bit confusing, I'm here to help. Send me your feedback. Send me your emails.